The biggest risk to your portfolio isn't the market, it's you. I've made my fair share of financial mistakes over the years. These are the biggest 5 and the ones you need to avoid if you want to be a successful investor. When you start out in investing, one of the biggest frustrations you'll have is just how slow it is. If you have £1,000 invested at a 10% return, that's £100. It's hardly game changing. It's the hardest bit of the journey before you allow compound interest to do the heavy lifting. And one way that can be very tempting to speed up this process is to borrow money to invest. If you can get a better return than the interest rate that you'll pay on the loan, you've almost got an infinite money glitch. Of course, the problem is the returns are not guaranteed. This was also a lot more appealing when we had ultra low interest rates for around a decade. You could get a loan for around 3 or 4% interest. Today, that's closer to 5 to 7%. And returns-wise, on an average annualized basis, over the last 20 years, we're looking around 8 to 11%. Over the last 10 years, it's higher, around 13 to 15%. But this was a situation I found myself in around 8 years ago, wanting to speed things up, living a life beyond my means. I've told this full story on this channel before, but in short, I essentially took out 2 loans, one for 15k and one for 25k. And the idea was I was going to invest this into the markets and profit the difference in return. And what I soon discovered is just how difficult it is meeting the minimum payments while still keeping as much money invested as possible. I had about £1,000 per month I needed to pay in minimum payments, but I didn't want to keep drawing down from the investments because I wanted to keep them working in the markets. And what that eventually led me towards is more risky strategies. What started out as long-term investing then led me towards trading and more speculative bets. I started using trading algorithms, which are very hands-off and very passive because you essentially input your parameters and it trades for you. So it takes the emotion out. And this actually worked really well in the onset. I was getting around 2 or 3% return per month, but you soon get used to that. And then I wanted even more. So I started manually trading. And again, this worked really well in the onset. In some months, I was returning around £10,000 per month on a loan that was costing me £1,000 in minimum payments. It was the dream scenario. But of course, all good things have to come to an end. And I was getting further and further down this rabbit hole, taking more and more risky bets, one step at a time. And eventually it led to losing all of the money while still having most of the debt still to pay. It's crazy to even think about this now and the decisions that I made and the consequences I had to pay in the years after. And it wasn't necessarily a straight line from taking out a loan to manually day trading. I'm not saying that if you did go down this route, that you'd automatically follow the same path that I did. But it's a very easy stepping stone from what started out as long-term investing to then wanting to get a little bit better return. And you just keep ratcheting up the risk until you eventually get to that point where you're essentially gambling. So however tempting a strategy like this may be, it's just not worth the risk. My first job out of uni at 22 was working in a contact center at Invesco. It was a lot of fun. Imagine a department around 80 to 100 people, all in their mid-20s. It was like being at uni, but having money. And on one hand, it was good that I got an early insight into investing, but also on the other hand, also had a massive opportunity to spend that money. There were social events every week. I made some great friends and we went on some amazing trips together. But this slightly goes back to the first point in that the hardest bit about investing is not seeing the monetary return in the early stages before we've allowed compounding to do the heavy lifting. And because you're not really seeing the monetary returns, it's so much easier to spend that money. I got into a good habit of investing regularly. I would save up to about 4,000 or 5,000. But then a friend would be like, oh, do you want to go to Vegas or do you want to go to Dubai? And we got on these trips. And I do think you've got to have balance, especially at that age. You've got to have that balance between living while you're young, experiences, and there are experiences that I'll never forget. But I do think there is definitely a balance to be had. And I don't necessarily mean you have to wait for this to compound all the way up to, say, £100,000, but maybe just get to around £20,000. At least then with the long-term average around 10%, we're looking at £2,000 per year. That's most of a big trip that you might want to go on. Where when you're only saving, say, 4,000, that 2,000, you're spending half of your portfolio on going on an annual trip. There is an element of patience here as well. We live in this Amazon culture where anything that we want, we can just order online and it can be at our door within a few hours. We want everything yesterday and we don't want to wait for our investments to compound and we get impatient. Hence, we're not really seeing the returns monetary wise. So we spend it. And because we're at a certain age, we always think, oh, we can earn that money later. And in hindsight, what I've learned is that so much of investing is about building good habits, having that monthly regular direct debit go out and having that fixed amount that's a non-negotiable. What you have left to spend after that from your salary is what you can spend on discretionary spending, but you don't touch that fixed amount. And when your salary increases, you can increase that direct debit in line. And even if that direct debit is only £50 per month, it's not necessarily about building up a massive monetary amount in the first onset. It's about building that habit and getting used to having that direct debit come out. You know that you're going to earn more later down the line and you can increase that later on. But this is about just getting used to that setup. I do think it's really important to have that balance though. We're not just saving for this future that's not guaranteed. And this is where I think it's important to separate out your investments. So some investments are very much long-term, that you almost don't need to touch that for a very long period of time. That's for retirement, or it could be for a very long savings goal, like a deposit on a house. But if you want to save up for a holiday, then have that in a separate pot. You might have 3 different pots with different time horizons, and you can select your investments accordingly. But having that structure is what's going to allow you to stay consistent. And that's one of the most important things with investing. This can be applicable to buying new things like cars or watches, but here I'm referring to buying investments, investing into whatever's getting traction. Be honest with yourself. When you look at a fact sheet for an ETF, for example, what's the first thing you look at? I bet for most people, it's straight to the past performance. We treat looking at past performance like we look at reviews on a website for a product. We want to see how good it is, and that's what we base that decision on. I think so much of this is just natural human nature. We saw so much of this more recently with gold and precious metals going on a massive rally. They get a lot more attention in the news, and that spikes people's interest. And they're more likely to invest into something that's been going on a massive rally, partly for fear of missing out, but also that we now think that this is a better asset than it was before. This does push us more towards cyclical investments because they're more likely to be outperforming in any given period, whether it be gold right now or oil, or in the stock market. We've seen tech stocks boom over the last decade. And there's now more choice than there's ever been before. Someone in my community mentioned the other day that there's now more ETFs than there are individual stocks. And I couldn't quite believe it, but it's true. In the US, there's now 4,370 ETFs listed compared to 4,172 stocks listed. And mutual funds is even more, 6,471. And what that says to me is that the providers and the creators of ETFs and investment products are not creating them because there's a gap in the market or they need to cover so many different bases. It's because they're trying to stand out. They want to create a plethora of different options to get people more active. They want us to invest into more products because that's how they earn money. And for me, this all comes back to having clear reasons about why you're investing into something. If you're investing into something that's cyclical or just because it's performed well recently, that can be all well and good in the short term. But at some point, that investment might struggle and it will go through a rough patch. And that can be really testing as an investor. And if you don't have those clear reasons, you may not have the conviction to see it through. And that's when you start to make bad decisions. That's when people end up selling investments when they're down because they don't really know why they're holding. Or they do know why they're holding it because it's performed well recently. And when it doesn't perform well, all of a sudden they don't know why they're holding it anymore. And then they end up selling it. And that's where we can make bad investment decisions. If you really want to simplify your investing, I have a free ETF cheat sheet you can download. It gives you my favorite ETFs across different regions and makes it really easy to compare. The link's in the description below. We mentioned before that one of the biggest headwinds to your portfolio is yourself. Often it can be not staying consistent or not setting clear goals for your investments. But a lot of the time, it's in your decision making in relation to time and effort. The philosophy of the more that you put in, the more you get out doesn't apply with investing. I mentioned in a recent video about trading 212 Pi is that one of the biggest mistakes that people make is rebalancing too often. And it's in this quest to have this perfect portfolio, but it all stems from not having a simple portfolio in the first place. And I think a lot of us start out with wanting a simple approach, a very long-term approach. We start out with a couple of investments. It may even start by using a global ETF, but we're encouraged to tinker with our investments because we're taught that complexity is going to be better with investing. And if we see someone with 20 plus holdings, that must be a better portfolio setup than just having our boring one stock portfolio or one ETF portfolio. I struggled with this working in the industry. You're looking at the markets all day. You're seeing what a client's potentially doing, or that this sector might be outperforming, or you read some marketing documentation and its whole goal is to persuade you that this area is a good place to invest. And it makes you feel like you want to and need to be more proactive. You need to be making these little changes. I remember looking at my portfolio back in the day and wanting to almost cover the whole world. Every region, every sector, every industry. I wanted to cover all bases because I didn't want to miss out. And in a way, you convince yourself that that's also diversified, ignoring the fact that you're probably overlapping investments and just making it far too complex. Rebalancing was a massive thing as well, wanting to keep the weights exactly what I first set them as. I was drifted 0.1% away from what I set. Oh, this is going to be too risky now. I need to bring that back. Or, oh, this is under now. I need to bring it back up. And back then it was even more manual. Today you can do that with a click of a button. And it's this quest to have this perfect portfolio all the time. Also because we want to see ourselves as an active investor. We want to be doing things and we want to be proactive in the markets. For most people, the best approach they can use for buying an investment is to buy it on desktop. Don't use the app. And if you do use an app, delete it straight away, because you don't need to check that investment for another 6 months. When you get to 6 months, then you can make some decisions about whether you might need to rebalance and you can see how it's been doing. But you don't need to be checking it on a daily basis. You don't need to be reading a news article and then suddenly get worried about whether you should be selling. Oh, I got in at the wrong time. Oh, my waiting is going to be out. If you bought an investment for long term, which most investments should be, 5 years plus, you don't need to be checking it on a daily basis, even a weekly basis. I'd say monthly is fine, but even you could stretch it longer than that. In a way, you almost want to do the opposite of what the platforms are trying to get you to do. They've made it as easy as possible to make investment decisions, but you want to put more barriers in place. So when you have to open your laptop, log into your account, that's more of a barrier than just opening up an app and making that decision. If there's one thing you take from this video, it's that it will never feel like a good time to invest. Even in a strong market, it will feel expensive and you'll want to wait for a dip. A bear market will bring you fear and you'll want to wait for a recovery. And a sideways market will just feel boring and it may even dissuade you from investing at all. Time in the market will always beat timing the market. Let me show you an example. This is looking at the FTSE 100 over the last year or so. And a big thing that investors struggle with is, especially in strong markets like this, is waiting for that dip that never comes. This massive dip here was on Trump's Liberation Day. So this was a bit out of the ordinary. But since then, the FTSE 100 has been on an amazing rally. And the problem is, if you're then looking to invest from anywhere from the summer of last year, because it's been so strong, you might then think, oh, it's really expensive, so I'm just going to wait for a dip. And in hindsight, we can see there's been a few dips, but actually they've been pretty small in the grand scheme. This one here, 2.5%. This one's probably the biggest one, and it's around 5%. But if you're waiting for a dip, are you really going to invest on 5%? You'll probably be waiting for a little bit of a bigger dip. You would have done this all throughout the summer and into this year, and that dip still wouldn't have come. So even if you invested up here, so this is at the end of August, it will feel like it's really expensive. It's hit a massive new all-time high. Even if you waited for that 5% dip and got in at the bottom, it'd still be investing higher than if you just got in at what felt like the top, or which was the top at the time. And it can be a similar story right now where the market is sitting at near all-time highs. If you wanted to invest around this sort of period and it felt too expensive and this dip wasn't big enough for you, well, to get back to there now, the market would have to come down around 10%, which is a pretty big dip. The correction we had around March last year after those tariff announcements was around 15%. And that was massively out of the ordinary. No one expected it to be that extreme of announcement. And those things don't come around that often. So you could be waiting a long time. And this is not to say that you need to FOMO into an investment just because it's been on a big rally. It's sitting near all-time highs right now. And what this hopefully highlights is that when an investment like the FTSE 100 has done in the last 6 months, new all-time highs tends to lead to further new all-time highs. And waiting for that dip that never comes, you end up being in no man's land, because you'll wait long enough that if it eventually does come, the market has already gone up enough that even when it dips, it's no lower than it would be, say, 3 months ago. Or you end up in a position where you've been waiting long enough and you can't wait any longer. And you just go, oh, sod it, I'm just going to invest anyway. And you invest right near the top, way more expensive than it was, again, say 3 months ago. And all these markets are very fundamentally driven. If a negative bit of news comes out, they can be massively affected. And you may be nervous about putting a lump sum in. And that's where you might try to time it, because you might have inherited an amount of money that you want to put into the stock market. And this is where sometimes on paper, what's best isn't always what's best for you. If you looked on paper, history would say that markets tend to go up more than they go down. So logic would say, get that money invested as soon as possible. But in these situations, sometimes you've got to take a step back and actually think how this is going to affect you emotionally. Even though you might not get as good return, potential return, you might be better still averaging into that investment. So you might park that money into cash or some form of fixed income asset, and then every month you invest into the stock market. That might turn out to be the better approach. It may not do. But you've got that peace of mind that if the market does come down, you're still averaging in. And if the market goes up, well, you've still got some money invested. So you're playing the average approach, which by definition is never going to be the best strategy, but it could be what's best for you. Let me know if you can relate to anything we discussed in this video. I hope you found it useful. Thanks for watching, and I'll catch you in the next one.